Hi folks, Chuck Gibson from Financial Perspectives with February 2018's Charts on the Move. We have much to discuss as February turned out to be something very different than past months. While we're still in a bull market, volatility returned as uncertainty surrounding inflation and interest rates and central bank liquidity weighed on investors' minds. The Dow and S&P 500 snapped 10-month winning streaks, their longest since 1959, while the Nasdaq posted a monthly loss for the first time in 8 months. For the month, the Dow, the S&P, and the Nasdaq closed lower by 4.3, 3.9, and 1.9% respectively. As you know, I'm not one to spend much time talking about fundamentals because they don't matter. Well, that is until they do. But just to establish a frame of reference for you, the S&P 500's 10-year price-to-earnings ratio ended 2017 at 32. That matched the peak valuation seen in 1929, just before the stock market crash preceding the Great Depression. There's only been one other period of rising stock prices that had a greater 10-year P/E ratio than we have today, and that was during the last months of the largest speculative blow-off of all time, the tech bubble of 2000. Outside of that period, valuations have never been higher than they are today. So when you consider historical ramification for equities, when both inflation and interest rates are rising, combined with the Fed whittling away at its balance sheet, it's critical investors understand the growing risks and have a plan. My plan for now is to gradually take our foot off the risk accelerator unless something changes in the future to materially change our outlook. There's no question on a longer-term time frame, we're still in a bull market. The shorter term, though, is bringing to light some cracks which are starting to appear in the foundation. Nothing's broken yet, so there's no need to panic, but the next few months will hopefully fill in some critical pieces of the puzzle as to which direction and when. Until then, we're in a consolidation, so be prepared for increased volatility and a test or two of your investment fortitude. An idea of what this consolidation may look like is to go back and look at the chart of the 2015 correction and that resultant consolidation. It turned out to be an ABC correction which eventually broke out to the upside. How this consolidation will unfold will only be known in the rearview mirror, but we have to give it the benefit of the doubt to the prevailing trend, and as such, expect it too to move higher. My next chart is a weekly look at the S&P 500 index. It should look familiar, as it was the same one shown last month, but updated to reflect current prices. If you remember, I spoke of the parabolic rise making the move unsustainable, and right on cue after releasing the video, the S&P took a tumble, falling a bit less than 12%. It should come as no surprise the decline found support right on the 200-day moving average. I mentioned in a blog post earlier in the month about how corrections typically follow an ABC pattern, and so far it seems as if the current one is following suit. In those patterns, the A wave is the first impulse move down. The B wave is the counter-trend bounce that falls short of testing prior highs. And the C wave, which signals the end of the correction, typically goes back to retest the lows created in wave A, oftentimes undercutting them. So if that were to unfold now, we would expect to see another move down to this area. What should be painfully noticeable is that in 8 short days, the correction took back the entire gains made in the 80 days prior to the sell-off. Stairs up, elevator down. The good news is price is still above its longer-term uptrend line and a rising 200-day moving average. Until this changes and we create a series of lower highs and lower lows, these nasty market hairballs are to be considered normal pullbacks. Most other stock markets don't look much different than the S&P 500 index, so I won't bother showing additional stock charts, except I do want to present the chart of QQQ, the Nasdaq 100 index. While some may argue it looks the same, and it is similar, there are some subtle differences worth mentioning. Notice how wave A fell short of the 200-day moving average, indicating a stronger market. In addition, wave B came within pennies of testing the prior highs, while the S&P 500 fell short of testing prior highs by 3%, again indicative of a stronger market. Accordingly, you would expect if wave C were to play out, the Qs to fall short of what the S&P 500 decline would be. Why this is important is because dip buyers armed with dry powder should be looking to invest available capital into those things that perform best during a correction. And the Qs clearly fit that bill. Let's switch gear over to bonds. Much of stock's recent angst are due to the continued and rapid increase in interest rates. My next chart is that of the 10-year Treasury yield. It should look familiar, as it too was highlighted in a recent blog post about the breakout move higher. As you can see, yields has so far inched within a cat's whisker of its target T1. To put this into context, the 10-year Treasury yield has increased more than 18% since the start of the year and more than 40% since last September. This is a staggering move and something stock investors are struggling with, and likely a good part of the reason for recent stock volatility. My next chart is that of the US dollar. It's very clear in hindsight to see how the dollar has begun a new intermediate-term downtrend. I was a firm believer before its breakdown the dollar would be moving higher out of that consolidation that occurred just above the blue horizontal line. Turning out to be completely wrong, I did not fight the message and rather embraced it by repositioning portfolios to take advantage of the dollar's breakdown. I continue to repeat, and here's the great example of how it's okay to be wrong, but you just can't stay wrong. Doing so can have a detrimental effect on your account. I still believe at some time in the future we'll be seeing the dollar go on to make new highs. But until that happens, we learned many years ago not to fight the trend, and that's exactly what we're doing. My final chart is that of gold. As you can see, gold is bumping its head up against that $1,380 resistance for the second time. That's one beautiful base it's formed over the last 4 years. Within that base, a pattern is formed which points to an upside target just shy of $1,700 if it were to break out higher. I must confess, I did something a little prematurely as I bought a small, 1/2 size position in clients' accounts before the breakout has happened. I hope this does not come back to bite me in the fanny. I am mitigating the early entry risk I took by taking on a partial position. So, if and when gold finally does break higher, I will be adding the final tranche to fill out the holding. Hey, wish us all luck. Well, I'm going to keep it short and call it a wrap right here. I do want to close with that it is my expectation we will likely struggle to move materially above prior highs as we're getting closer to entering a seasonally weak period. Whether this year turns out to be like last, where market ignores seasonality patterns, we'll only know after the fact. Until then, we must respect the possibility and reset expectations accordingly. Till next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening. Until next month, this has been Chuck Gibson from Financial Perspectives with February 2018's Charts on the Move.